All right, so this is going to go really quick. We're going to talk about smart money moves, but we got to talk about the tax bill. If you missed the 1 o'clock tax talk by these two guys, we're going to cover the highlights. Why don't you guys give us some highlights, and I'll click through.
Sure. Can everybody hear me okay? Okay. Yeah, so we had a 1 o'clock session where we sort of dive deep on the one big beautiful bill and the different tax laws that now are applying more and that apply to everybody in their own situation. One of the big deals was that it extended the tax cuts permanently. Now we say permanently in air quotes because it's as permanent until the next Congress comes in and changes it. But what happens is, what it did was it gave our tax brackets, we put our tax brackets in a lower range where we could do more conversions, we can do more tax planning now, and again, the whole idea of paying the least amount of tax over your lifetime. That's the overall goal. So, yeah, and then we talk about the idea of RMDs. RMD stands for required minimum distributions, correct? But what we tried to do is we tried to flip it to the idea of trying to maximize our tax brackets, not looking at just the minimum, but ultimately how can we maximize our tax brackets to pay the least amount of tax over our lifetime. And so we want that tax planning to ultimately drive our distribution planning. That's what we do at Akers Financial Group, is our goal is to pay the least amount of tax over our lifetime. And so that, in our opinion, is maximizing the tax brackets, which are now at a lower rate than what they could have been. And so also taxes could go up in the future. I spent quite a bit of time in that 1 o'clock class talking about I do believe taxes will go up in the future. So let's pay taxes when they are at their lower rate now.
All right, so these some of these slides are from Ed Slott. I'm a master tax expert through them. What that means is we do classes, about 32 hours of classes a year on tax law for IRAs, which is a lot of fun. Then I come back and train the office on all the ideas so that we're up to date on as much as possible. The current president works 7 days a week, changes rules 8 days a week. And so we're just trying to work with in all those to try to apply it to your situation. The financial forums that we're doing today, the key idea is to give leading edge information to you that we're doing with our clients right now, so you can understand why we want to review, why we want to know your taxes, why we want to do a tax estimate, why we want to make sure we're collecting all this information from your financial fingerprint to deliver the right answers for you. All right, so these are the actual tax brackets that are now permanent. These are the brackets of 10, 12, 22, 24, 32, 35, and 37. I generally point out the difference between 12 and 22 is a 10% bracket. 10% more taxes, almost a 50% increase in taxes for each dollar above that limit. And then we have the next sort of important piece is from 24 to 32, and that's where you jump 8%. So those are our targets when we're trying to do our Roth conversions and our maximization and our tax planning, is looking at these brackets, seeing where you are and where you might be, trying to plan through all this. What's your thoughts, Noah?
Yeah, I'd like to just point out, I mentioned this as well as our earlier class, that when you are in that 22 or 24% tax bracket, not all of your money is taxed at that 22, that 24% tax bracket. So when we're saying a little bit may have leaked into the 22 or 24% tax bracket, just whatever went over that step, that is what's going to get taxed at that. The rest is going to be, it's like stair steps. So you see that first number at 10% goes up to $23,000 and married filing jointly. Then the next step is after that, it goes up to 12, then 22. So we really like filling up that 12% tax bracket. That's why Paul was talking about required maximum distributions. We want to maximize your distributions during that smaller tax bracket, because we know the tax law now. We don't know what it's going to be in the future. Might as well try to pay as little tax now instead of a lot of tax later.
Yeah, so the idea here is tax bracket management means we got to know what we're doing this year. When we move our money into things that pay higher interest, higher dividends, and that shows taxation, we then got to watch that. And our portfolio designs on taxable accounts, we have to watch out for efficiency of their investments. You'll notice that we are doing more tax-efficient portfolio design through Brookstone Capital Management, tax-aware portfolios. Through the use of ETFs, we can have portfolios that are trading without triggering capital gains. Unlike mutual funds that can truly trigger a surprise on the last day of December each year. Now, you guys are going to handle this little chart for me?
Yeah, of course. I'll go ahead and start. So a lot of the new law that was written in OBA, which was 1,000 pages long, and then there's just a section that was on tax, had to do with the standard deduction. So the standard deduction has increased as inflationary adjustment as it normally does each year, but we also have a new $6,000 additional deduction for seniors. So if you're over the age of 65, you make less than $150,000 AGI, then you can get this $6,000 per taxpayer. So married filing jointly, that's an additional $12,000. Yeah, I'll keep going. Yeah, so we've got the state and local taxes. So there's when it comes to the below the line, the deductions, there's the standard and there's the itemized. Really what we see, just to try to sum it all up for you, is that it will be more difficult to itemize this year. But that doesn't mean that you shouldn't stop reporting your itemized, your state and local taxes, your charities, your medical deductions, your mortgage interest. You should still give that to your tax professional, just because there's also that new limit of adding in whatever you give to charities. You can give up to $2,000 that will add into your standard deduction as well. So that standard deduction is getting that $6,000 additional for people over 65, under $150,000, and then another $1,000 per taxpayer that you can get. So that standard deduction has just grown with the recent tax changes. That's a lot like it was a couple years ago with the charity. It was $300 per taxpayer, and this year and the next couple years, they've allowed us to go up to $1,000 per one. So when we're comparing the tax returns, we have a lot more room for Roth conversions, which is something that we do on the financial planning side, where we really want to fill up those income brackets, which have gotten even larger thanks to these larger standard deductions.
Yeah, so smart money moves is we take the taxes, your income needs, your cash flow needs, work all within that, and then prioritize it. If you need cash for a new car, a new bathroom, whatever, you have to do that first. And that's taxable withdrawal out of certain accounts. And then you take money and use that for conversion if we can afford to do that. If you're working a part-time job, you can do Roth contributions. There's no age limit on that. But these tax laws can help us with the planning to accomplish your goals. The smart money moves is if we're in Roth, typically we're more aggressively investing in the Roth because that money is built to grow over time. So the One Big Beautiful Bill has made a lot of rule changes that are only good for the next 4 years. But generally, the permanent rule is the tax brackets are permanent until proven otherwise. It also made permanent the $15 million estate limit I covered last class, and allows for small business deduction and real estate profit. There's some deductions under QBI, which is an interesting line on your tax return.
Yeah, we like to say that the tax law is written in pencil. It can always be erased. It's not in pen.
Will you say that?
We said it earlier. Ed Slott says it a lot. I get this every day.
Well, so Noah's the managing partner of Daniel Allen Tax because my father, Danny Akers, stopped doing the tax service. He listened to his grandchild better than me. And so Noah was able to take it over and digitize it, use technology to help our tax people deliver quickly, more efficient our tax services. So as we're going over this today, we're really trying to cover the tax laws a little bit. All right. Now we're going to cover just some Akers Financial core thoughts. So income from low earning investments. This is when you're looking at your portfolio. And earlier I talked about we have a cash cow herd of investments. Which cow do you milk first? Now, if something is not earning its keep or you can't get any milk out of that cow, you might need some hamburger. You might need to take that cow to the butcher shop. You like that one, Dean? Yeah, okay. but the idea is this. When we're designing a portfolio, we've got to watch taxation, how much it's earning, and what is the best way to draw money. Have you done that before, Paul?
Yeah, I think that's the whole idea in tax planning on the Akers Financial side is that you might call and say, hey, I need X amount of dollars. We need to create income streams. Our goal is to help work through which of those cows are we milking, which ones are going to give us the best milk per se.
You never liked my milk, my cow.
I know. But the idea of ultimately tax efficient investing, drawing income from the lower earning investments makes sense to do. And it also allows us to have our higher earning investments to continue to grow for us. And so that's why we love to utilize the idea of like creating income from the indexed annuities to guarantee income. And then ultimately that allows us to take more risk and allow for better growth on our market side.
Yeah, so by watching your tax bracket, you can have your decisions on your options, your choices. And so you might need to fill up. So imagine you have buckets at home, your checking account. We don't keep too much in checking, but then the next level might be saving or CDs. And then you build other buckets that then begin to be invested over time. Tax brackets allow us to maximize. We can fill up these other buckets, giving us access in the future. Now, as we're designing this, we have to watch tax brackets and something called IRMAA. What's IRMAA, guys?
Yeah, IRMAA is not something you want to be familiar with in your retirement. It's essentially where your income, depending on your level of income, you will pay more Medicare premium. Okay, and so the IRMAA is also based off of a 2-year look back, right, Brian? So your income 2 years ago will affect your Medicare premiums now. And so when we do this tax planning, and we're talking about maximizing the tax brackets, we want to maximize tax brackets, but we also want to watch out for IRMAA levels. We want to watch out for, as we talked about with this big, beautiful bill, there's income thresholds to these additional standard deductions. So our job as your financial advisor, as your financial planner, is to be doing that for you and to make sure we're doing the most tax efficient investing.
Because what we want to do is make your money last a lifetime. We want the income to last as long as you do and have a legacy left over for your family and kids. So we're trying to design portfolios, investments, and letting that grow. We want to have your income stream as you need, be efficient on the tax, bring all of that together, and that's true financial planning. So smart money moves that AFG is making right now is we do core and satellite investing. You guys mind just explaining that a little bit?
Sure. You want it or you want it? Yeah, so the idea of in our approach of managing money, which is wonderful that you're going to get to hear another 30 minutes of this after diving deeper into the portfolios, but we do believe there's a core and satellite approach to the way we manage money, meaning we use core models. Our core models we use Brookstone as the models for being able to build those out, but a big part of that is we don't utilize bond funds. We use bond replacements. Bonds can fluctuate up and down depending on interest rates. And so when we talk about having money being truly protected, I want your money to be truly protected, meaning cannot go down with the market. And so our approach to it is smart money moves is that in the balance of risk and protected in a portfolio, our risk side, we want to take less risk than the overall market, but we still want to grow at market returns. But then on our protected side, we want to take zero risk. That's the whole idea.
All right, so core and satellite. Core is going to be portfolios that we're going to talk about in a few minutes. AFG Select, we have core diversified portfolios. Satellites is where we can take more risk if we want the money to grow, all the way up to the level of crypto management, or less risk, adding things like buffer the downside. We can have treasury bills, CDs, things like that. But throughout the design of the adding on to the core, we can reduce the risk or we can raise the risk based on the need that we all have.
Yeah, it's great to have those additional satellites in your portfolios as well as having that strong core that we build out. So we've been building out the core for the past couple of years, as Bernie and Alex will also be talking about later on, but getting that extra special little bit of satellite in there. I want a little bit more growth. I want a little bit more value. I want to dip my toe into some more aggressive stocks. And we want you to do that, but conservatively, smartly, ideally, to have your feet firmly planted on the ground, well diversified, and then also take those extra steps as you're moving forward. Something that we do that I hear a lot of other advisors aren't doing is that whole financial plan, looking at it from every angle possible. We try to see that diamond, let it sparkle in every shining piece of it, and then attack it from investment planning so then it coincides with how we're planning on the tax side and make sure that it's meeting in line with your goals for the estate planning. So when we advise about your investments, your core, your satellite, your annuities, your life insurance, your everything that we put together, we try to build it specifically for you. And we're doing it for ourselves as well in our own money management.
So I've always believed that financial planning is the only way to make decisions on your financial life. Without a financial plan in mind and knowing where you are, we call that your financial fingerprint. Without walking through your situation, your goals, what you like to accomplish with your money, how can we then dictate the right investment? What is the right investment for you? The planning gets us to that point where we get the right amount of risk that we need to take. Generally, in retirement planning, we want to take the least amount of risk to reach your goal. We don't want to keep going at the highest amount of risk to reach your goal. We like to dial it back and balance it so that we can maintain that money throughout your lifetime.
Yeah, the funny part is the core part of managing money. If you actually look at it over a longer period of time, the steadier rates of return that you get over a longer period of time, they're better than having the higher volatility, taking more risk, more upside, more down, more up, more down. To have the steadier return over a longer period of time, which is what we do in building our core and satellite approach to investing, while also building out our protected, is what allows our clients to retire and stay retired. Meaning that income's going to be there to last you the rest of your life and have some left over if you want to leave legacy to your family.
All right, so there in this section, our smart money moves, the idea all starts with the planning. Now, in the environment that we're facing in the economy, there's a lot going on between the tariffs and sort of the tariff tantrum of April causing the market to drop dramatically, and then the incredible recovery out of that has brought the market to all-time highs currently. As we talk over the next half an hour and into the next hour, we'll have our different portfolio managers go over really what we're trying to do on a day-to-day basis managing money. But that all coincides with our investment that we do for you. I believe that the way you set your account up, like Roth IRAs, typically I'm more aggressive with that. Money that you need tomorrow, we have no risk in there. If we want to set up income, I like that to be guaranteed, so that's always going to come. You don't have to go to your bank and check to make sure it's always there. It's always coming. I like that. I don't like the idea that let's do an if plan. It might show up. I don't really enjoy that as part of financial planning. So Akers Financial Group, we have teams of advisors. Those teams of advisors work with groups of clients, and we work the same way. We bring financial planning, discussion items where we write about you and your exact situation. We do need information from you to get it all together so that we can provide the right answer. And that really is the key to our approach, is understanding that it's not just where you are now, but each and every year where you are. We can't see where all your money is because of the way that you have your money outside and you have money with us. We will report to you about the money we have, and then we bring it all together so we can make decisions on when to withdraw and how to withdraw so you pay the right amount of tax. All right, well, thanks very much, Paul and Noah. I appreciate that. In my 20s, I had my first company. I became the youngest CFP at the age of 23. But what I really wanted when it came to investments is I wanted to build a portfolio of the best in every category. Because if you look at firms, they all have certain things they're really good at. But when you build portfolios at a family of funds, they'll be good at part of it, but you get discounts if you have all your money at one place. It took technology a long time to be able to help us deliver a way to manage money where we get to pick and choose the allocation, do the trades for you, and pick the best in every category. So in our investment committee, we meet on Mondays at noon, 2 to 3 times a month. On that committee, we have our research analysts, which is Alex Monk here and Bernie McVey. They also help me with being portfolio manager. I'm technically the portfolio manager, but Mark DiOrio out of Brookstone, out of Chicago, is the portfolio manager of AFG Select Portfolios. And what we're going to do here is cover that and go over. Let me show a little picture of Alex.
Yep.
How many years ago was that?
Fairly recent. So if you saw some of the pictures from last night's dinner where I had hair combed over, I don't know how many people knew me then.
How many years you been here? 13 years?
13
years. Yeah, so Alex Monk was one of my assistants, and one of the assistants, they learned a lot. Took him a little longer to learn it all.
I like to know everything.
Yeah. Right.
So, you know.
And then we unleashed them to the public as an advisor. Alex has his own team, and a guy named Sam. Sam Huff is back here. Assist Alex in delivering financial planning for all of his clients, and he's also a co-host on our radio show. Now, Alex is sort of the lead person with our portfolio manager and communicating with Brookstone. We, as a committee, work on allocation changes, portfolio changes. We then go to them. Their portfolio team reviews it with their investment bankers, and then they will say yes, and then we'll say go. They'll do the trades, and then your portfolio made changes. So we also invited up to stage Bernie McVey. Bernie McVey is a former client of Akers Financial Group from the 90s. It wasn't Akers back then, it was just me as an advisor through another firm, to be named later. Bernie, as he got ready to retire, we had a conversation about retirement. I said, what are you going to do? He goes, I'm going to come work for you. And I said, you're hired that moment.
You call that retirement?
Well, it was compared for what you were doing.
Oh, yeah. Yeah, what I was doing was pretty intense.
Yeah, he was your last job at Northrop Grumman was what?
I was chief information officer for the company, and I worked out of Falls Church, Virginia.
And traveled the world normally. So he had a lot of pressure, you might say, for his years at Northrop Grumman. And so it's been easy, more fun doing investment committee, right, Bernie?
Absolutely.
All right, so Bernie is mostly retired, but he's our advisor on Mondays. He's fully licensed still. Him and I have some clients together. We work on things, but it's been very enjoyable to know Bernie for over actually 28 years, I think. I've known Bernie McVey, so it's been really good. So what we're going to do now is just cover AFG Select portfolios, and go ahead.
All right, so we're gonna get into like the overview philosophy, and I think Bernie's like our oracle, so I'm gonna let you kind of go over that.
Okay, so we have 4 different funds. You can see them on the bottom of the chart there. Growth and income, moderately aggressive, and diversifier. And our philosophy on all of these funds is to, invest for growth, but to have risk less than what the market offers. In other words, a beta of less than 1. So a beta is a term that talks about the volatility of the S&P 500. And so the normal volatility is a beta of 1, and we want our models to produce significantly less than that while still offering growth. And that comes back to Brian's key philosophy of, protecting what you've earned, right? And so while this is the risk-on portion of your portfolios, we're trying to be quite responsible with the assets that you put into our models, into our funds.
Yeah, and I think the best thing that we do is, like Brian said earlier, is we want the best in the categories, right? So we're able to go out there and say, who's the best at just broad market exposure, right? Like, I don't want to pay somebody an extraordinary fee for them to buy what the S&P 500 does. We don't need a rocket science to do that. But when it comes to things where it's sensitive, like when we do have some type of income management in our growth and income model, we want to have a manager that's going to actively manage whatever piece we're hiring them for. Just like you have a CPA that does your taxes, my lawyer doesn't do my taxes, he doesn't fix my roof. So everyone's got their niche, and that's what we're out there looking for. Now, when Bernie first started coming to work for us and really started to get to know him, gold wasn't one of those assets that was being talked about like it is today. We have a philosophy to own some gold because it protects things when there's inflation. We've seen inflation, and it took gold a while, but this is a normal holding for us in our portfolios. It has been since we've started. It's there for exposure and to give us some flexibility for when markets do move. So I just wanted to not be a gold and silver enthusiast for no reason, but you were the guy that opened our eyes to really how that international and that currency risk can really be handled. And now we're seeing it. And all these things are happening in real time because the world's changing rapidly.
Right. So one of the things that we look for in each of these portfolios is an asset class that will move in a direction that the other assets in that portfolio do not move. And so that's one of the roles that that some of our metals holdings and some of our commodities holdings will provide in an inflationary environment. So when one thing zigs, the other zags, if you will, and that again dampens the volatility and provides what we hope will be, you know, as was stated in the previous section here, some normalized returns as opposed to, you know, up and down and all around.
Yeah, so the portfolios we have there's four. Growth and income, typically designed to give income now. So it has higher yield with still broad diversification. Up there on this is our current allocation as of right now. It's the secret sauce. That's the actual funds, the ETFs, right?
And you see things up there, and a lot of them are in my brain, and my brain thinks different. Like CNBC's on
They're in your brain.
24 hours. Like I see different things.
No one should be in your brain.
When I hear utilities, I'm like, oh, somebody needs income. I'm not sure everybody's brain works like that. So a lot of those names for me, it's like, why wouldn't you have that? But we own assets in this portfolio that are out of favor right now. Real estate. Everybody hates real estate in the market. Well, it still pays a good dividend. So we're looking for good quality managers and also income from different streams. We have some from equities, some from growth, some from interest. So we try to spread that cow theory, herd theory.
Herd. We spread out the herd. We have multiple cows. So the cow's not spread. That's terrible to do to a cow.
Because if they fall,
we have different cows.
yeah,
And that makes the whole herd.
heard that.
You heard that. That's right. Next portfolio, moderate. Yeah, Alex is one of the funnest guys on the radio show. Everybody enjoys him. It's hard because I try to focus him on the topic, and he distracts it. But we have a lot of fun,
We do have a good time.
and that's why you get voted top radio host with me.
Well, they can't see either. So
That's true. Moderate portfolio. One of our core portfolios and most portfolios is to have AFG Select moderate. AFG, Akers Financial Group, we select a moderate portfolio. That's my brain, how I named it. It makes sense to me. We picked them, and this is our portfolio, and then our investment committee designs it, and these are the current allocation we have now.
and you'll see names in there that you're going to recognize, right? Like you're going to see Fidelity Contra Fund, or you're going to see just S&P index funds, things that you're going to be like, oh, I know what that does. And then you're going to see some other stuff where you're like, what is that? And that's where we're using different things to achieve different results through, I think one of my favorite things is shareholder yield. Do you want to touch that?
Sure. Shareholder yield is an interesting category. Most funds are focused on dividends, which, you know, are cash returns to the owners of the funds. What shareholder yield is concerned with is not only the dividends, but it focuses on companies that are buying back their shares. Now, what's the value of buying back shares? Well, obviously that takes shares out of the market and increases the price, but it's also not taxable. And so those buybacks do not pass on to you in terms of actual like a dividend check would. So we're very interested in those types of funds. I'll also mention the sliver down there around exponential technologies and Explorer Admiral. Those are some of the high-flying kinds of technologies and companies that that you wouldn't find necessarily in the S&P 500, for example. So.
And then we have a little bit more risk in a portfolio called moderate aggressive. These core portfolios are designed truly for our near retirement and retired people. These are not designed for our 20 and 30-year-old clients. We do the core and satellite. We add the extra salt and pepper on top of it to spice it up, or whatever spice you like.
Yeah, I would say one of the things that we do in the investment committee is we try to think about what are the current evolving trends in the market, right? And we want to be there first. We want to be there ahead of the herd, if you will, back to your. And so you'll see things
We like the herd. That's us. We're the herd.
We like the herd, but we look at things like that cybersecurity fund. Well, that's a huge player in the market today. Information protection is very important. And so we think about, what's next. And, it could be, infrastructure related to energy, or it could be maybe even like nuclear. There's a lot of work going on, you know,
And
to
all,
get
all
clean
that's
energy.
leading to AI because they're supplying and supporting AI, right?
Yeah, it has to. I mean, we need a ton of energy to support AI. And so we're thinking about, you know, what's next in terms of changing these portfolios to get there ahead of the herd so that we reap the benefit of that.
And AI just doesn't mean you go out and you buy a chip company and you buy whatever internet company. It means you look at how AI can be implemented across all the sectors. Who's going to be able to adapt that? So that helps you in other sectors that you weren't really seeing as AI benefactors. So right now, while the market is very focused on AI at its all-time highs, we can look at who's been implementing this correctly. And we'll go over some of the changes we made earlier this year.
All right, so as we move to the fourth portfolio, this is called diversifier. This is a portfolio designed not to be U.S. stock related, to diversify away from someone that might be a federal government employee with a TSP all in the C fund. So we want to have a diversifier where we're actually away. Now this design is heavy on the real metals. What else?
Oh yeah, we were heavier gold 5 months ago, and we added some energy and a little bit of extra silver here, which is finally taking some upside back. I think silver's got a long way to go just based on history. Energy was a little early. I think we're going to be there sooner or later. And then we have broad basket commodities. We actually reduced our international exposure inside the fund earlier this year because of the run up inside the diversifier. Because if international's the leader at the middle of the year, well, then we need to resize our other portfolio positions. Because if we have asset classes, like Bernie said, are zigging and zagging, we're always looking to see who's made outsized moves one way or the other and who deserves more or less of our overall allocation.
Right, so as the investment committee, we do look at capital gain taxation on our trading. So if we trade your portfolio, it's going to trigger realized capital gains. So we're watching our trading points, watching what we trade, trying to avoid short-term capital gains, also trying to manage the money over time. And so we've had different things. Last January, January 29th, in the AFG growth and income portfolio, we made some trades.
Yeah, so this one was more like, Brian touched on it earlier in the earlier hour about tax efficiency. Well, old school mutual funds, if you just own it, you might get a check or a 1099 in the mail and say, hey, you owe some tax. So we switched over to an ETF structure, which doesn't have those type of force outs. In this fund, it's not a huge change because of the way it works, but it does give us a lower expense, a little bit higher income, and that allowed us to rebalance things back to target. This was done kind of a one-off thing earlier in the year as interest rates were about to move. So this is the one portfolio we have that will have some fixed income exposure. So it gets handled slightly differently.
But then May came along, and we did some more trades in May 16th.
Yeah, so May, we went through the tariff tantrum, whatever you want to call it. April, was it April?
April.
Yeah. So we are back, and the market's trying to pick the new winners. Companies are trying to figure out what's happening. Well, last year we went defensive around May, and we were wrong. It didn't happen until April the following year. So the reasons we went defensive for never came, but at that last year at this time we were like, hey, it's time, something's coming. So we added some defensive names. This year we sold them all. They are all up double digits in the year holding period. And our trigger to do this was gold either hitting 3,500 or the trades becoming long-term. It happened within 5 days of each other in May. So we got rid of our more defensive positions, made some efficiencies through ETF changes, and then also went back to some overweight market exposure.
Yeah, I'll just add that both of those dates were, taxes were in the forefront of our thinking, right? We waited until January so that any taxes due on the sale were pushed into April of next year. And the May one was really around, making sure that we got past the year point of our prior portfolio changes so that we turn short-term into long-term gains.
Yeah, so the portfolio is really trying to grow, watch market trends, not be short-term day traders, but long-term outlook. And so going defensive, and then April seeing the market go down, and then seeing the other pieces all tie together, gave us a real obvious signal to then go into the market, and then the market's done really well now. And now, once again, we're going to have to look at this as we have fall into the end of the year to see if there's another opportunity. We're going to talk about that in just a minute. Now, these are some changes in the moderate aggressive portfolio.
Yeah, so the moderate aggressive, we have probably somewhere, I don't know exactly, but a 5% overweight to technology as compared to the moderate model, and then a little bit extra in foreign and smaller mid-cap companies. They both have allocations to gold and silver. We resized those because they were up when we made the trades in May. Looking back on it, gold was going to rip and run. We should have waited. But we did the right thing. It hit our marker. We still have our gold and silver positions. But picking technology is going to add volatility. I mean, the dot-com bubble, 99, the last 6 months of it, the NASDAQ doubled and then took 15 years to come back. Like those days happened. They will happen again. For some reason. That's why we are always going to pick different markers to take any type of emotion out of investing. Right? You can turn on the news any day and you can get a whole bunch of reasons to sell, to buy, to do this, to do that. But what you're not going to get is somebody sitting across from you that's telling you how this impacts your life, because we know everything, and then we know everything about you, sorry. Well, not everything.
Focus.
Sorry. Anyway.
All right. So the idea is, our core thoughts is that volatility of April led to changes. We did that in May. We went out defensive, went more aggressive, and then that leads us to this sort of outlook for the rest of 25 into 26. Now, I'm going to start out by the idea of interest rates and the government shutdown right now. Government shutdown, they're not reporting our unemployment rates. So when they laid everybody off early in the year and they're actually off the payroll here in October, we're not seeing the unemployment numbers. So that helps. But once these numbers get reported and everything comes out, what we're going to see is the ability for markets probably to have some more volatility, and I believe ultimately lowering of interest rates a little bit more in the calendar year. What do you guys think?
So I think that's generally right. I mean, I think there's
like
a
to be
lot of
generally
uncertainty. There's a lot of uncertainty in the market. It's related to, tariffs. It's related to interest rates. It's related to pending court decisions around tariffs, and pending court decisions, could impact the market significantly in the very short term. But again, we need to kind of just see that through, I think. We're appropriately hedged with some of the commodities and holdings. And I think the one thing about the market that I believe is that we will continue to see, some devaluation, if you will, of the dollar. I mean, it's down about 9% already this year. And, that's showing up in some of our increased prices around not just the metals, but also the commodities and so on. And I think we're positioned to ride it through. And I think once we get through the shutdown and some of these decisions, assuming they are completed in a responsible way, I mean, I think the market is headed up.
Yeah, and gold being so high, with all the markets being around all-time highs, is a little cause for concern if there wasn't such a weak dollar. One of the easiest way to deal with international tariff change is by having a really weak US dollar. It helps pass on all those costs because it's not felt by us, the consumers, 100% yet. Eventually that will change, and we will see it. How that is impacted in earnings and how the market digests it, yet to be seen. And also, different sectors are going to get impacted versus others, how retailers price things. It's all uncertainty, right? This is all new. It's all changed. And I agree with Bernie. Like we're poised for what they can do.
I mean, I think there's also, the market is also digesting, frankly, some political risk that's going down right now. There's a lot of unrest around, and how that's all going to get itself resolved. Will it resolve itself peacefully, or will it go some other way? So I think in the short term, there's some real uncertainty. But again, I think longer term, I think the bets are right.
Okay, so at Akers Financial Group, we have our select portfolios. In our 4 portfolios, we're managing about $120 million for clients currently. Our overall active management is about $295 million. And overall at Akers Financial Group, through all the diversified portfolios, we're about $550 million. We've been very blessed to have a growing company, very blessed to have wonderful clients that help us and trust in us to build these portfolios out. By adding these special value about the AFG Select, we take our core beliefs in their investments and apply it and have the ability to trade the accounts all at one time. And that discretionary ability is truly how we can keep our hands on the portfolio and get us in the right spots at the right time.
And you mentioned earlier that technology has changed so much
yeah.
in this space just since we've been working together.
Yep.
Like the ability for us to use our scale without having to go to one company to get their product or this or that, which ultimately would create bias for us. We had to figure it out. Like for a while, it just took manual labor, and we just had to keep
Well, the
doing
first
it.
portfolios, they would have to do every trade. So Bernie and Alex have to enter every trade, right? And I would be on them like, hey, did you get them all done? Oh, we never got done. It's 4 o'clock. Well, you should have traded them all in one day. How can we do it in one day? You had these conversations because I want a button. Let's get it done. The hard part is we're able to
They
do that.
didn't give me that button. There is that button.
There is a button now.
But we didn't. They were like, oh.
Yeah. Well, compliance, advisory services, all kinds of decisions in life that you try to implement a financial planning firm. Things are moving fast. Things are moving quickly when it comes to AI through design. The Akers Financial Group, we have to add value for our clients. That value has to be that we listen to you in your exact situation, and then we take that situation and then apply it and implement the investments, everything we do to make it work for you. Now, some clients, we call them our plus clients, they fully are all in with us. And we enjoy knowing their situation, managing their money, making the decisions, and handling for them. Now, some clients, they're not going to do that. They're going to say, here's some of our money. You manage that. We'll have this money over here. So our planning meetings, we have to know what you're doing on the outside so that we can build around it, build around what you're doing on the other side. Now, the hardest part as a financial planner, we would love to be all plus clients where we manage everything for you. But all of us are built differently. And there's only, like it's like cards. You might say, hey, Akers Financial Group, here's this card. You might give another card later. So the more we know about your situation, the more we can actually understand what you want out of your money. Then we can give financial planning advice. But this leads to our implementation. And by having our financial forum today, I want you to understand why we do these things, how it all works together in our mind, so that you can have that comfort and trust to know that things are being taken care of. So we thank you very much for listening to our talk, this one. We have one more financial forum talk. We're going to have a market update from our manager, Mark Diorio, out of Chicago, and then some more further talks with other advisors that are on the Akers Financial team. So you have about 10 minutes till we start again at 4 o'clock. Thank you very much.